If you regularly max out your pension's annual allowance, which is usually £40,000, make ISA contributions of £20,000 every year, and use your annual CGT allowance, offshore bonds can offer a great next step to further increase tax efficiency. On top of this, people earning over £240,000 can have their pension annual allowance reduced right down to £4,000, depending on their earning levels. So an offshore bond can offer a great additional option in this scenario as well. An offshore bond, or international bond, is simply a tax-efficient wrapper that is issued outside of UK jurisdiction. The word offshore can cause people to make the incorrect assumption that these are highly complex tax evasion vehicles, and this is simply not the case. They are closer to the vanilla end of the spectrum and often make up part of well-diversified tax planning for high earners. In a similar fashion to a pension, you can invest in a wide range of assets within an offshore bond, such as equities, bonds, alternatives, and property to ensure that your funds grow over time. There is no tax relief applied to contributions to an offshore bond, but there are some other great benefits. Offshore bonds are not subject to capital gains tax, so capital gains can roll up over time without any immediate tax charge. Gains will be taxed as income, but only when you come to access the funds. So whilst there is no relief on the way in, there is no tax to pay whilst the funds grow, and income tax is only applied at your marginal rate when you take withdrawals. A key advantage of the bond is that the holder of the bond can make 5% withdrawals of the original capital each year without suffering a tax charge. This is a cumulative allowance, which means if you don't access your annual 5%, it will build up so you can draw more than 5% at a later date if you need to. What this does is it allows you to maintain some immediate tax-deferred liquidity if you need it, whilst your money is growing in a tax-efficient environment, which is a great thing. The key to using an offshore bond successfully is by first starting at the end. You need to ask yourself, how are you going to get the money out? What's the exit strategy? If you're a high rate taxpayer, it's a great tool in the armoury if you get it right. You can invest your money to achieve capital growth and reinvest dividends without having to pay any income tax whilst you continue to earn income over and above the top rate. But it's important to remember that whilst there's no immediate income tax to pay, there will be income tax to pay in the future. So in an ideal scenario, a higher rate taxpayer pays the money in and a non or basic rate taxpayer draws the money out. That might sound like an unlikely scenario, but it could be more common than you think. So let's take a look at an example. James is 40 and earning £312,000 a year. This means he is fully tapered out of his pension, so can only make contributions of £4,000 per annum. He maxes out his ISA contribution of £20,000 a year and puts another £20,000 into a general investment account every year to utilise his capital gains tax allowance as the pot grows. So where to next? Well, an offshore bond allows James to invest his money without suffering capital gains tax or any immediate income tax charge whilst he continues to earn high levels of income. So James decides to put another £20,000 a year into an offshore bond. By the time James retires at 60, assuming a net growth rate of 5% a year, he would have just over £2.1 million to fund his retirement. James would like £80,000 a year in retirement. So to achieve this, he takes £5,000 from his pension, which is within the personal allowance, so it can be accessed tax-free. He then takes £25,000 from each of the remaining 3 wrappers to cover the other £75,000 of required income. The £25,000 taken from his ISA is tax-free. The money taken from his GIA is a taxable event, but he crystallises a capital gain under his annual capital gains tax allowance to access this £25,000, so this is also tax-free. Now for the offshore bond. James has built up just over £400,000 in capital within the bond, so he can access 5% of this capital, or £20,000, free of tax every year. The remaining $5,000 of income will be under his personal allowance, so will also not be liable to income tax. By the time James is 80, he'll have used up his original capital withdrawals from the bond. At this point though, he'll have a range of options to maintain his full tax-free income. Because he held the bond for 20 years and a rule known as top slicing, he'll likely be able to continue to access a substantial amount of the money from the bond with no tax to pay. On top of this, his ISA will likely have grown enough for him to supplement his income further from there. So there you have it. James thought he had very few options because his pension's annual allowance was fully tapered. With some clever planning though, and the use of an offshore bond, he's managed to take £80,000 a year completely free of tax throughout retirement. This is an overly simplistic example to demonstrate the main advantage of an offshore bond, but hopefully it provides useful insight into how you use them. There is a whole array of other benefits to holding a bond, particularly if you're a high rate taxpayer looking to give money to your children over time, so they can be useful in lots of different scenarios. You've probably gathered though that it's likely to form part of a broad financial strategy, and it's really something you shouldn't consider without taking professional advice. So if you're a high earner and you are looking to reduce your tax position, it's definitely worth considering the benefits of an offshore bond. Because remember, your money really does matter.